Hey, Bowtie Nation, Joseph Hogue here with another live stream Sunday. Thanks for joining me. I love these Sunday live streams. Been a couple of weeks since we've been back. I'm trying to do these every other week if I can get them into the schedule. But thanks for being here again. Just love doing these informal chats. I can take off the bow tie and relax a little bit and just kind of talk stocks with all you out there in the nation. So I see a lot of people already in the chat there. Let me know if I'm coming through all right, and where you're coming at from there out there in the nation. Got a great video planned for you today. Stocks are already up 18% so far this year, which is actually about double the whole year returns over the last 30 years, right? Last 30 years average annual returns is about 8.5% for the S&P 500, which so yeah, we're already 7 months in and double that. And you get all these calls for corrections or even crashes throughout the market. I know it can scare a lot of investors out of the market. Those calls for corrections are getting louder, and sometimes it even becomes a self-fulfilling prophecy, right? You get so many people calling for a 10% correction or a stock market crash or something that, so the second something goes bad, everyone jumps out because of those calls, and it just kind of feeds on itself. But what I want to do today is, talk about the market, talk about what it's at. But I don't want you jumping out of the stock market, okay? Because nobody ever made money that way. Nobody ever made money by going all to cash and not using their money to make money for them, okay? Instead, I want to give you 3 ways to invest in stocks for that safety that you need, but to also keep on making those returns. So again, thank you for being here. I see Chattanooga, Tennessee, Germany, Maryland, Southern Maryland. Love Maryland. I was there, stationed there for my MOS school in the Marine Corps, actually at an Army base there in Maryland. Great time there. Real close to Baltimore. Loved Baltimore. Denmark, Israel. Thanks for being here. Always love seeing everybody out there in the community here in the live streams. So I want to get started here. I do want to invite everybody to get a free report that I've partnered with Motley Fool over. A lot of people they don't want that. They just want to invest and not worry about the stock market, right? So for that, I usually suggest kind of forever stocks that are going to go up no matter what the market does over the long term. So with the Motley Fool, I put together 5 stocks that I'm investing for the next 30 years. These are actually the 5 biggest stocks in my own portfolio, the ones I'm holding and not even worrying about. So it's totally free report. Look for the link. I've linked that in the chat above, and then I'll put it in the video description below as well as the first comment. Click through, sign up for that. You'll get that free report. Motley Fool is going to send you some emails. You can delete them. You don't have to. There's no obligation to sign up. I actually do use the Motley Fool Stock Advisor for ideas and just kind of some of my research because I like the service. But absolutely no obligation, and you'll be helping support the channel. So I appreciate that, and look for that link there in the chat. But I want to get to it though. We'll talk about that topic, and then we'll do Q&A. I always love answering questions back and forth with all you out there in the community. If you missed last week's videos, we got one video in particular that kind of talk about why I stopped investing new money in tech. I still got a lot of tech stocks in my portfolio, and still do believe in that longer term trend for tech and a lot of these, but there's some very real reasons why I've stopped putting new money in tech, and I'm now shifting a lot of my other investments into other assets or even other stock sectors. So check out that video. That was from last week. Next week we've actually got a new strategy here on the channel, a video that I'm going to share how I double my return with some ultra safe investments, right? And this is actually an investing strategy used by closed-end funds, used by a lot of mutual funds, and a lot of funds out there where they'll take ultra safe investments like mortgage bonds. They'll take treasury bonds and corporate bonds, even highly rated corporate bonds, and they'll leverage those up to get a much higher return, but still keeping that safety in those types of investments. So very important for a time like this when the rest of the stock market is undeniably expensive and volatile, is looking for those ultra safe investments and how to get a little bit more risk on those. But I want to get into that topic because again, especially over these next couple of months, you're going to hear a lot of calls from experts and analysts and pundits on TV about a stock market crash or a correction, and I don't want it scaring you out of the market. Okay, August and September are historically the worst 2 months for the stock market. If you look at average returns by month over the past like 70 years, even August and September are actually negative months. Okay, the stock investors on average over that period have actually lost money during those 2 months. It's even more than even worse than October, which is generally considered that big crash month, right? Because that's when the 29 crash as well as the 2000 or the 86 crash. Both of those happened in October, but actually August and September are even weaker months. So you're going to start hearing a lot of people talking about a stock market correction. And, stocks are undeniably expensive right now. We can look at the sector tracker here on spider.com. That's sectorspider.com. All you out there in the nation know this is one of my favorite resources just for kind of tracking stocks, where they're at, and kind of getting an idea of what sectors of the economy are outperforming, underperforming, kind of that shift that I like to look at. So sectorspider.com, it's the sector tracker here, and you can change this for over a day, 5 days, a month, all the way up to year to date and 5 years. And what we look at, stocks in the S&P 500 index, that broad market index, are up 18% over the past or so far this year, which again is about double the average annual return on stocks, which is just amazing. And then you've got some real standouts here. Energy, financials, both up 30 and 28%. Real estate up 27%. I think real estate, a lot of people, besides the snap back in property prices, right? So a lot of property types really fell hard last year, especially retail, hotel, a lot of those hardest hits. Those have been rebounding this year, but also people are looking at real estate and REITs and real estate stocks as a way to hedge against inflation. So that sector is doing really well. Technology is actually underperforming, though it's beating the market slightly, doing 19% so far this year. But is well off of the 44% I think it did last year. So you can kind of use this as an idea of where stocks are at right now. And there's I really want to talk about three risks, right? Three stock market risks that we're looking at for the rest of 2021. Kind of talk about why these are and where these are, because you're going to hear a lot about them, in the markets over the next few months. So I want you to understand where these are coming from, and then we're going to address each of these with some strategies. How to invest for each of these risks, right? So first we can look at. First, I want to look at the FactSet earnings insight, and so the first risk here is really that earnings growth is slowing. Stocks are expensive, and really the stock market is that forward-looking machine, right? The stock market is always okay. So what do you got? What do you got for me now? I know we did 85% earnings growth over the last quarter, but what about the rest of the year? What about the next two quarters, right? And that's really why the market is kind of weak right now. It's looking at a second quarter earnings growth, and you can see that here in the FactSet Earnings Insight, the research. The S&P 500 earnings growth for the second quarter. That's the quarter that was just reported or is just being reported right now. And you can see here stocks in the S&P 500 posted 88% earnings growth this last quarter versus the quarter in 2020. Of course, last year, everything was hit by the pandemic, so so that was artificially low a little bit. But even a lot of these are just now reporting quarterly growth well above 2019 as well. So just amazing, really amazing earnings growth over the last quarter. But the Q3 is only expected at 27% year over year. Q4 is only expected at 21%. Year-over-year earnings growth, right? So the market is looking at this analyst expectations and saying, okay, well, you know what? We've got slowing earnings growth, even though 27 and 21% is pretty darn good for annual earnings growth. But then they're looking even further out, 9.7% earnings growth expected next year. Okay, so the days of those double-digit 88% earnings growth year over year are over. Next year we've got more of a normalized 9.7% earnings growth expected for companies. And what happens if something comes along to even limit that upside? What happens if we get new taxes or inflation that can't be passed on to consumers, so companies have to eat that, hitting their profit margins and hitting that earnings growth, right? So that's really what the market is looking at now. And for clues of how volatile this is making the market, you just look at some of these big tech company earnings, right? And some of these other earnings that have been released over the last few weeks. Amazon was down 7%, even as it booked the third consecutive $100 billion quarter, right? So Amazon in their second quarter earnings booked the third $100 billion quarter that they've had. But they lowered their forecast for the rest of the year, said, admitted that sales were going to be a little bit lower, growth was going to be a little bit lower, and the stock got hit 7% on that. Even though they beat expectations for the quarter, they did very well. Facebook also, down almost 4%, just on warning that slowdown in ad sales is coming. Okay, a lot of these tech companies, especially the internet, the online companies, did very well over the last year, saw huge sales growth and earnings, but now they have to come to the grips of the reality of the slowdown in that growth, and investors are punishing them for it because stocks are so expensive right now. Stocks have built in a lot of that growth. And now, when reality comes knocking back on the door, then stocks are selling off. Okay, Apple was probably the most recent case. Just warned last week that iPhone and iPad sales were probably going to be a little bit lower than expected on that chip shortage, the shortage in semiconductor chips, and it doesn't expect the same kind of growth that it did last year. And of course, investors sold off on those shares a little bit. So, that's really the first risk, is just that macro, that larger environment where, we don't have $10 trillion from the Fed and from the government pushed into the economy over the next year. We don't have, interest rates that are going to be rock bottom over the next year or 2 years. And we are starting to see that growth slow down. So that's the first risk here. Another risk, of course, obviously something we got to talk about, is the Delta variant of the COVID virus. And if you just look at daily new cases in the U.S. alone, you can see here they've really spiked over this past few weeks. We hit a low of right around under 10,000. Actually, we hit under 10,000 new cases in the U.S. On a daily basis here in June, and then that Delta hit, and we've been over 100,000 for pretty much the whole week. We hit 131,000. That's the most since basically February, since early February, late January. So that is going up. Now the thing here is it's not really it's not translating into deaths and stuff. Hospitalization rate is going up, but not quite as much as we saw earlier in the year and last year, because it's generally newer people, or it's younger people, it's people that haven't gotten vaccinated, things like that. But it is still affecting the economy, and it will affect the economy. The New York Auto Show just last week was canceled. So you're starting to see some of those mask mandates come back. You're starting to see some of those cancellations. So really the worry is that the Delta virus, as it keeps creeping up, is going to affect the economy and slow down that growth even further. But I don't think it's really the U.S. you have to worry too much about, right? Because, again, we're in the U.S., it's about 50% of the population. It's about 55% of the adult population is vaccinated. A very high percentage, closer to about 70% of the people, those higher risk populations of 65 and older are vaccinated. So again, we're not seeing it translate into the hospitalizations and the deaths that we saw earlier in the year and last year. Okay, so that combined with the fact that people just don't want to lock down anymore. People are going out and they want to do stuff. So I don't think it's going to hit the economy quite as much as it will. Where you have to worry about is more internationally. Okay, a lot of other countries are way behind on vaccinations. Compared to the U.S., the EU, the U.K., and that kind of thing. So you're going to see more lockdowns. You're going to see a harder hit to the global economy from those. And I'm going to share one of those investing ideas, those strategies, later on here after this next one. And this last risk, this final one, is just inflation, right? That is the 600-pound gorilla right now in the room. Inflation is really, guiding where the market is going to be. Okay, and it's likely to be longer lasting than the Fed and all the economists think. Right? We hit 5.4% inflation last month. We've got the we've got the CPI, which is the Consumer Price Index, and the PPI, the Producer Price Index, hitting this week. Okay, Wednesday and Thursday. And why this is important, because a big support in the market right now, right, is just that monetary stimulus, right? The Federal Reserve, the central bank, is pumping $120 billion into the economy right now. Okay, even though employment is coming back, the economy is looking good, they're still pumping that money into the system, trying to support the economy, trying to grow the jobs picture and things like that. Right? They're buying bonds, they're pushing cash out in the economy. They've still got rates down about zero right now, right? And the whole idea here is that the Fed does this until the employment picture is back to where it thinks it should be, right? And that's generally right around 3.5% unemployment, 4% unemployment, somewhere around there, right? So it's been saying that, okay, inflation's not a problem, we don't have to worry about it, we're not overheating the economy by pumping all this money into the system, because we've got supply bottlenecks, we've got a labor shortage because of the pandemic, and that's what's keeping inflation high, right? So again, they've got the two arguments that employment really hasn't come back and inflation isn't a problem. Well, Friday, we got the monthly jobs numbers, right? The monthly jobs numbers almost hit 1 million jobs created in the U.S. last month. It was like 940,000 something, right? Way above estimates. And the first month that's close to that 1 million jobs created point in months, right? It's been disappointing over the past few months. But the unemployment rate plunged by 0.5%, which is a huge move in the unemployment rate. So that really took a lot of the argument out of the Fed for why they should be pumping money into the system still, and why rates should be so low. Okay, and you saw that sell-off in tech stocks on Friday because of that, because people are getting worried that the Fed might have to raise rates. They might have to stop that $120 billion monthly bond purchases a little bit earlier, because one, unemployment is coming back, or employment is coming back. It's rebounding, so that takes away one argument, and inflation is still very high. And that takes away the other argument. So, Wednesday and Thursday, we're going to get those inflation numbers. And if those are higher than expected again, you're going to see the market sell off because, people are going to start questioning the Fed and the central bank and Chair Powell and everyone there about the temporary nature of this inflation. They're going to start saying, okay, well, maybe inflation is, a little bit more than just temporary, right? So, you take these three risks, and all this really hits at a time when with high stock market valuations and really the worst 2 months for stocks, right? So it's kind of a perfect storm for a correction. Because if anything goes wrong, if any of these three hits, then it could be an excuse for investors to take profits. Like I said, a lot of people are calling for that crash or the correction of 5 to 10%. And so, when people hear that, they jump out of the market when anything goes wrong, and that just kind of feeds on itself, and stocks fall more and more, and you get that self-fulfilling prophecy. So again, I don't want you to do that. I think that you can stay in the market. You can use the some of the sell-offs as a buying opportunity. Now, with that said, don't think that every time stocks fall, every day stocks fall, that's a buying opportunity. You got to pick your battles here. You got to wait maybe a 5% correction, maybe for stocks to fall 5%. So it's going to be over maybe a week or two as stocks lose a little bit of that value, and then use that to buy on the dip, right? Because, in a year where stocks are expected or the economy is expected up 7%, you don't get a stock market crash. You still could get a correction of 5 or 10% or more even, but you don't get a crash. So I think you wait for stocks to sell off a little bit, wait for valuations to come down just a little bit, and then you use that to buy on the dip. But don't be jumping in every single day saying, oh, I'm buying on the dip because the NASDAQ is down 0.5%. That's not really a dip, okay? That's just a one-day fluctuation, all right? But I want to share these three strategies, three kind of ideas on how to invest, how to position in this market. And the first one is going to be something like a U.S. focused on stocks, right? Stocks with sectors with less international sales. And what I'm looking at here is a couple of different ideas. One is the U.S. trade deficit came out again. The monthly deficit came out just this last week again, a record $75 billion deficit. Okay, and that's generally not great for an economy, right? To run up that much of a deficit. Basically, that says that the U.S. We bought $75 billion more in goods and services from other countries than we exported in that month. Okay, which is a huge deficit. And of course, you can see here. Since 2016, since way beyond that, it's been a deficit, right? And this picture really paints a picture of the global economy, right? Like I said, we've always in the U.S. it's run a deficit forever. We always buy more than we sell in exports. But look at the change here since the trough in the pandemic, since last year. Imports into the U.S., so the goods and services that the U.S. is buying from abroad has really taken off, right? Whereas exports, they've come up, but not nearly as much, right? So that gap has spread, that increasing deficit, and it's really because the U.S. economy has rebounded, has recovered so much faster than most of the rest of the countries, right? Most of the rest of the world, okay. And again, because of that Delta variant of the virus and where a lot of the rest of the world is at in the vaccinations, I think this is going to continue. The U.S. is going to continue growing at a really fast pace, and you're going to see a lot of the rest of the world, maybe ex-EU or UK. The UK is doing pretty well as far as vaccinations. The EU is doing pretty well as far as that as well. But the U.S., it's a high level of vaccination. They're opening up. They're still spending a lot of money. The Fed and the central or the federal government, right? We got $3.5 trillion in stimulus in the annual budget coming to hit the economy pretty soon. Whereas a lot of other countries, they're talking about removing this stimulus. They're talking about bringing back increasing rates and things like that, especially China. So I think you're going to see the U.S. economy continue to outperform, on this, and really, obviously, that's going to affect stock prices. Okay, so if we go back to what you want to do, if you go back to like the FactSet research here, and I want to go to page 23 is where it is, and what we're looking at here is going to be companies or sectors. So companies within sectors that have relatively less exposure on international sales, right? International revenue, okay? Because if the U.S. economy is booming, but the rest of the world isn't doing quite as well, then you're going to see that international revenue weaken, okay? You're going to see a lot of companies that are dependent on revenue from overseas, from other countries, they're going to weaken. They're going to post, negative surprises on their earnings because that revenue just isn't there, because those economies just aren't rebounding quite as fast. So you can use something like this to kind of get an idea of the sectors where companies are less reliant on that international revenue. Okay, so we start off here, on the left. The dark blue here in these bars is U.S. revenue, on average for the sector. The light blue is international revenue, right? So you can start. You start here on the right with the highest international exposure, and you've got IT companies, technology companies, right? A lot of those are pretty much integrated with international sales because a lot of the stuff is built overseas or whatnot, and then they very much depend on other countries, sales in other countries for a big portion of their revenue. You got materials, consumer staples. So for information technology, 57% of the total revenues in that sector is from international sources, right? Just 43% on average for companies in that sector, for tech stocks in that sector, just 43% of the total revenue comes from the U.S. sources, right? You've got materials, so that is also a very much internationally focused sector. You got about 55% of revenue, so more than half of revenue for that sector comes international sources. Consumer staples, 45%. So another big one, communication services is where And with communication services, that sector, you always got to think of that in two parts, right? The internet services, the internet companies, more tech kind of companies, right? And the telecom stuff, right? Because there's the telecom companies within that communication services that are very much U.S. focused, U.S. based, that kind of thing. Whereas the internet companies, a lot of the other companies in that communication services sector are much more focused on those international sales. I don't know why they combined the two. A lot of those companies used to be in the IT sector, but they combined them a couple years ago. So you can just look through here, and energy, healthcare, a lot of these in the middle. But then you look over to the left here, utilities. So utilities companies get 97% of their revenue from U.S. sources, right? Obviously, it's very much a U.S. monopoly on the electricity, the gas, that kind of thing. Real estate as well only gets 17% of their total revenue from international sales, right? And again, this is kind of obvious, this is kind of intuitive, right? Real estate companies, they own real estate in the U.S. They lease that out, commercial property, and that's where the revenue and the sales is. Financials as well, a lot of the banks, the lending banks, commercial banks, things like that. So, if you're looking at companies or looking for companies with less dependence, less reliance on international sales, as the rest of the world or a lot of the rest of the world kind of struggles with that economic growth, then you look at these sectors. You look for companies in these sectors, these utilities, real estate, financials, even into consumer discretionary a little bit there. So that's one of those ideas to kind of handle the risks in that. Another one, the inflation protection, right? And for this, you're going to want to do two things. You look at companies that have the ability to pass on those inflation costs to customers. Okay, this has been a huge thing in those second quarter earnings. More than 8 in 10 companies during the second quarter earnings pointed to inflation as a big worry for profit margins and for earnings over the rest of the year, right? They're seeing huge increases in commodity costs, in their input costs, things like that. And they're worried that they're not going to be able to pass those costs on to consumers, right? So, if the company's expenses get higher, but they're not able to raise their prices, then the profit goes down, and earnings are gonna be weak. So you want to look for companies that are able to pass those costs on. And we've been talking about these in the Daily Bowtie quite a bit lately. The daily market newsletter we put out, we found liquor companies, right? So Diageo, you've got Ambev, Constellation Brands, right? Ticker STZ, I think. These liquor companies are doing really well, actually, because they've got the premium brands that people are gonna buy anyway, right? They can pass those costs on to the customers. Customers aren't very price conscious because they've got one brand of scotch or one brand of whiskey that they really like. That's all they drink, and that's what they're going to keep on drinking, right? So things like that. You've got the fast food companies that have actually done really well as far as passing those costs on to consumers as well. I think McDonald's said their menu prices were up 6% year over year, in the last month, and not seeing any drop in volume, right? They're not seeing any drop in traffic because of that increase. So fast food companies have done really well, and those look a little bit more protected from that inflation that is actually really hitting a lot of these other stocks and a lot of these other sectors. Another thing you want to do, and this takes a little bit more work, a little bit more research, but it's a great way of getting this idea of who is inflation protected, is just looking at the gross margins, right? So what you want to do when you're looking through your stocks or you're looking for new stocks to buy, you go to their income statement, right? And it always starts off with sales, right? And then after that, it'll say like gross sales, or it'll have cost of goods, which is what they pay, right? In their it's what they pay for their inputs, the commodities that go into their sales or into their products, right? So what you do is you look at that gross margin. So what is left over after paying those cost of goods? What is left over after paying the input costs on their products, right? And you want to see some kind of consistency. Okay, so for example, and here let's just do a real quick one on this. I just want to show you kind of an example of this, how to look for something like this. So let's go to Apple. Okay, and we'll go to the financials, and you go to the income statement. The income statement is where where a company is going to report its sales, its earnings, all that kind of good stuff. And okay, and so you see, first thing it starts off with total revenue. Okay, and then cost of revenue. Okay, this is cost of goods and services. This is basically, like I said, this is everything that Apple is paying to produce those products, right? Cost of goods, their input costs, all the supplies they're buying, things like that. And then you're gonna have this total gross profit. Okay, this what's left over of their sales after paying these input costs. Okay, and so what you want to do, you want to compare the new stuff, the most recent quarters and most recent years against. And we'll change this to quarterly so we can see more recent stuff. You want to compare that to the longer term, right? So if we look at the most recent quarter we have here, Q3 of 2021, Apple reported 81. Let's bring up the calculator here. 81.4 billion in sales and 35 billion in total gross profit. Okay, so total gross profit 35 billion divided by 81 billion in sales. Okay, so they had a gross margin of 43%. Okay, so 43% of their sales were left over after paying these costs of goods and services, these input costs to their products. So how does that stack up against what they've done in the past? And what you need to do really is you need to do this over over a longer period, and you take different you take each of these quarters, but we'll just do it one here. So let's go Q4 2019. Okay, so they made 43% gross margin this last quarter. In Q19, well, Q3, let's use Q3 since it's the same quarter. 20 billion in gross profit divided by 53 billion in sales, and they did 37% gross margin. So they're actually doing better. Apple is actually increasing their gross margin. So just based on these two numbers, it doesn't appear like inflation is really hitting Apple, at least over the last 2 years. Okay, from Q3 2019 to this most recent quarter, they're actually increasing their gross margin, so they're able to pass on those costs. Now, what you'll see here is if you look at a company that is having a problem with inflation, what you're going to see here, and you're going to see this probably in a lot of consumer staples companies, your Kellogg, your ConAgra brands, a lot of those consumer staples companies are really getting hit with this idea of inflation. What you're going to see is that gross margin is going to be decreasing. Okay, maybe they're both posting higher sales or higher revenue each quarter, but those expenses, those costs of goods sold are going up faster, right? So they are able to pass some of those costs on to consumers, and that's coming in at higher revenue, but their costs are rising faster, right? So you're going to see this total gross profit as a percentage of that, you're going to see that fall. So you're going to see lower gross margins, right? And I know this is a lot of work. I know there's a lot of research and stuff, but this is very important. Inflation is the number one thing, the market is watching right now. So you really got to make sure that the companies you're investing in, those stocks, they're doing a good job at, either controlling those costs or passing those costs on to investors. And this is how you find that out. This is how you watch for that, is watch those gross margins on that. And the last strategy here is just going to be kind of diversifying into other assets and other sectors, other assets, but really into other assets. And I know maybe a lot of you aren't ready for cryptocurrencies yet, Bitcoin and Ethereum and that, but I got to tell you, it's one of my highest conviction ideas, investments right now. It's less correlated with stocks. So basically, even if we do see some stock market weakness, we can still see Bitcoin and cryptocurrency prices increase. And in fact, I think so over the last, if we go back at this sector tracker and we could look at, so over the last month, stocks have increased 2%. Not bad, but you've had some real sell-offs. You've had energy down 6%, over the last 5 days. Stocks are up about 1%. And if you look at cryptocurrency prices, Bitcoin is up something like 20% over the past month, right? So obviously they're uncorrelated, Bitcoin prices with stock prices. So it's an opportunity, right, to kind of diversify your exposure a little bit. So even if we do get some kind of a sell-off in stocks, then your entire portfolio isn't going to be hurt quite as much because you got those other asset classes, whether it's stocks, bonds, real estate, cryptocurrency, things like that, right? So it is, it is an option there. Now I want to talk about, I want to turn this into the Q&A portion of the chat, because, or the